Today, I'll be taking you through why Johnson & Johnson might be a potential investment opportunity. As one of the leading global healthcare companies, Johnson & Johnson is renowned for its well-known brand, diverse product offerings and strong market presence. We will go through quantitative and qualitative analysis of the company to gain a better understanding of a potential investment in this stock. Johnson & Johnson's strength lies in its diversified business model, spanning pharmaceuticals, medical devices and consumer products. This diversification helps it navigate economic cycles. With one of the largest R&D budgets in pharma, J&J covers a wide range of medical areas, including neuroscience, oncology, and infectious diseases. Its medical devices serve orthopedics, surgery, and vision, while its consumer products include baby care, beauty, oral care, and over-the-counter medicines. First, let's crunch some numbers through a quantitative analysis. For Johnson & Johnson, a current ratio of 1.11 means that it is in a relatively safe liquidity position. While not a large buffer, it indicates that the company has more current assets than current liabilities, but the margin is fairly narrow. Regarding the company debt to equity, this indicates that for every dollar of equity, the company has 52 cents in debt. This suggests a moderate level of financial leverage. The company is using a mix of debt and equity to finance its operations. It is not overly reliant on debt, but it is also not entirely equity financed. This level of debt could indicate that the company is using borrowed capital to potentially boost returns without taking on excessive risk. Johnson & Johnson had almost $89 billion revenue in December 2024. This shows a 4.3% increase in revenue when compared to December 2023. The company's profit operating margin of almost 19% also reflects this when compared to nearly 17% from the previous year. Regarding its net income of $14 billion, the company had a 60% decrease when compared to 2023, but this is explained by the fact that the company ceased consolidating the results of the consumer health business in August 2023, around $21 million. However, it continued to reflect any separation costs incurred as part of discontinued operations through the end of the fiscal fourth quarter. In 2023, Johnson & Johnson spun off its consumer health business to create a new, independent company called Kenvue, which now operates as a standalone entity. By looking at its earnings per share, the company had a decrease in its EPS due to various transactions throughout the year of 2024. These included a one-time special charge, acquired IP R&D charges, and other costs associated with the acquisition of V-Wave. This is due to discontinued operations. J&J is generating more cash than before with a total free cash of almost $20 billion, reflecting an 8.5% increase in relation to 2023, which can be used for various purposes like paying down debt, reinvesting in the business, returning capital to shareholders through dividends or share buybacks, or funding strategic acquisitions. In December 2024, Johnson & Johnson had ROE of 20%, whereas in the previous year it was 51%. The decrease in ROE is explained by a combination of factors. The spin-off of Kenvue. In 2023, Johnson & Johnson completed the spin-off of its consumer health business, including brands like Tylenol and Neutrogena, into a separate publicly traded company called Kenvue. This restructuring significantly impacted J&J's financial metrics, as the consumer health business was a significant portion of its overall revenue and profitability. The decline in COVID-19 vaccine sales. The COVID-19 pandemic and the subsequent vaccine rollout led to a surge in demand for J&J's vaccine, but as the pandemic receded, sales of the vaccine declined. The loss of market exclusivity. Some of J&J's key drugs like Stelara have lost market exclusivity in the US, meaning that generic versions of these drugs are now available, leading to reduced revenues. Johnson & Johnson's payout ratio is 84%, which means that 84% of the company's earnings are paid out as dividends, while this number was only 33% last year. This was also due to a combination of factors. Declining COVID-19 vaccine sales. As the pandemic receded, the demand for J&J's COVID-19 vaccine decreased, impacting revenue from this previously significant source. Falling Remicade revenue, a major drug for J&J, faced competition from biosimilars, leading to a decline in revenue from this product. Increased competition. J&J's pharmaceutical portfolio faced increased competition from other companies, potentially impacting sales and profitability. Uncertain macroeconomic environment. High oil prices and elevated interest rates could have contributed to a general economic slowdown, affecting J&J's sales and profitability. Stelara loss of market exclusivity. Stelara, another major drug for J&J, lost market exclusivity in the US last year, further impacting its revenue. And J&J faces unresolved talc suits, credit rating risk. The company is juggling lawsuits for its role in the opioid epidemic and over accusations that the talc once used in its baby powder had caused cancer in some customers. Although a strong financial performance is a good indicator of a company's health, we also need to look at the non-numerical factors that can affect a company's success. It's about understanding things that can't be measured directly with numbers, but are still very important for a company's growth and future. Like brand recognition. Johnson & Johnson is one of the most recognized and trusted brands in healthcare, with a diverse portfolio spanning pharmaceuticals, medical devices, and consumer health products. Its well-established reputation makes consumers more likely to try new products launched by the company. When looking at the news, especially on social media, can cause significant short-term fluctuations in J&J's stock price. For example, reports about product recalls, litigation outcomes, or regulatory changes could influence investor sentiment quickly. However, such news-driven price movements are often short-lived and don't necessarily reflect the company's long-term value or operational health. While short-term news can create volatility, Johnson & Johnson's robust fundamentals, diverse product lines, and innovation pipeline help stabilize its long-term outlook. In regard to its leadership, J&J has consistently had strong leadership in place, with a deep bench of experienced executives. Their ability to navigate challenges such as regulatory hurdles, market competition, and global health crises, like the COVID-19 pandemic, has allowed the company to maintain stability and growth. Strong leadership can lead to smart acquisitions and restructuration of the business, like the recent buyout of Biomed, which strengthens J&J's medical device division and the spin-off of Kenvue. By looking at emergent future industries with the growth in biotechnology and immunology, J&J is well-positioned in the biopharma space, especially with its focus on immunology and oncology. As biotechnology continues to expand, J&J's research and development investments are driving the future of treatments in chronic diseases, cancer, and more. Also, when it comes to shifts in sectors, the company is making significant strides in integrating robotics and artificial intelligence in surgical instruments, especially through its acquisition of companies like Auris Health. This emerging sector is poised to disrupt the medical device industry, and J&J's involvement can create substantial future revenue streams. Likewise, the rise of digital health solutions and telemedicine platforms presents both challenges and opportunities. J&J is actively exploring these new sectors through strategic partnerships and technological innovation, integrating digital health tools into its offerings. Shifts in healthcare delivery models, like the increased use of telehealth, may prompt J&J to adapt its business strategies to continue reaching consumers and healthcare providers. Here are some examples of these factors that can influence the investor outlook when analyzing Johnson & Johnson Company. These factors combined influence Johnson & Johnson's stock performance, and investors should consider both short-term fluctuations and long-term trends when evaluating the company's growth prospects. In a summary about the quantitative and qualitative factors that portray a company's snapshot, Johnson & Johnson Company positions itself as a strong, consistent, and solid company with growing opportunities and providing value for its shareholders. It should be noted that the company has been restructuring its business, and in 2023, Johnson & Johnson spun off its consumer health business to create a new, independent company called Kenvue, which now operates as a standalone entity, and this led to a reduction in the company's net income and earnings per share in 2024. EPS also included a one-time special charge, acquired IP R&D charges, and other costs associated with the acquisition of V-Wave. Other factors to consider were the spin-off of Kenvue in 2023, the decline in COVID-19 vaccine sales, the loss of market exclusivity of Stelara, the fall in revenue from Remicade, increased competition, an uncertain macroeconomic environment, and other unresolved talc suits affecting the company credit rating risk. These contributed to the company underachievement when looking at metrics such as the ROE and dividend payout ratio. However, the company still has a strong brand and is restructuring its business through a strong leadership to better position itself for future growth and keep up with industry innovation, in particular with AI technological advances. By looking at Johnson & Johnson, we saw that the company had an 84% payout ratio and EPS of $5.79. The company has been consistently paying a dividend of $1.24, as of December 2024, per share quarterly and continuously growing. The company has a solid dividend yield of 3.15%, and the growth in dividends has been steady along the years. When looking at the stock performance in the yearly graph, the current price is down to around $140, but at the beginning of March 2025, the price was at its highest yearly value of $159, so now it could be a buy opportunity as we see a potential correction in the short run. When looking at the 5 years period, the stock had a continuous growth up until 2022/2023, when it peaked at its highest value of $176, then it decreased and stabilized in the last couple of years at the $150 mark. Johnson & Johnson had a solid 2024 year, although it went through some major business restructuration. The company still presents itself as a strong and potential candidate for long-term investment, and it is adapting its core business to sector challenges and future technological developments. The COVID pandemic also took a hit on the company performance, With continuous dividend payments and a solid dividend yield, the company still presents itself with great investment potential for the long run. Stock price is in a potential pullback due to recent lawsuits and other macroeconomic factors, but it might present a buying opportunity, as the stock value is at an annual average. Thank you for watching my channel. More analysis like this one to come in the future. Tell me in the comment box which other companies you would like to see here in the future.